On Friday, S&P Global Ratings affirmed South Africa's rating but kept the outlook negative because of low growth expectations and political concerns. Contingency liabilities, high unemployment and fiscal consolidation are also issues that have once again been flagged. The agency lowered the country's local currency debt to BBB from BBB+, but kept the foreign currency rating unchanged at BBB- with a negative outlook.
We are seeing South Africa's institutions continuing to be resilient. And then secondly, we continue to see the government being committed to fiscal consolidation path despite the environment of weaker economic growth. And then thirdly, we are seeing South Africa's external position improving compared to our last review in June. So all these factors were supportive to the affirmation of the foreign currency rating.
In the last 6 months, since S&P, Fitch and Moody's made their calls, economic growth for the second quarter of the year printed much stronger than many had anticipated at 3.3% growth. Inflation has remained relatively stable. The currency has stabilized, and there have been improvements with regard to the state-owned enterprises.
The agency warned that South Africa's rand-denominated debt purchases pose a risk to the fiscus. Government debt is expected to rise to 54% of GDP by 2019. S&P again warned that the country's parastatals are a significant risk to the balance sheet.
We could revise our assessment of contingent liabilities into another weaker category if we see the utilization of government guarantees increasing, particularly for Eskom, which is one of the major institutions with a large usage on the guarantees, and also if we don't see the reforms that government said they want to do on turning around state-owned enterprises with weak financial balance sheets.
With all the political wrangling over state-owned entities, the government will have to get its house in order soon.
Standard & Poor's, as well as the other two ratings agencies, are likely to take South Africa to sub-investment grade unless we just impressively and deliberately reverse recent economic performance. It's really economic growth, unemployment that the ratings agencies are after. And there is nothing in the near term on my radar that suggests that South Africa is about to reverse this unimpressive performance.
Efforts between government, business and labour to turn this economy around are being praised in the wake of these ratings announcements. However, there's still a lot more to do before most plans materialise, and it won't be long before the ratings agencies will have to deliberate on this economy again. Sumitra Nydoo, CCTV, Johannesburg, South Africa.